So as we all know, software drives today's economy. And because software requires few assets to generate large revenue streams, physical assets have become largely irrelevant. So today I'd like to talk about 1stDibs. They're an online marketplace. They sell luxury items such as high-end furniture, interior design, fine art, and jewelry. But today I just want to do a little deep dive into the operating expenses of 1stDibs, specifically focusing on how sales and marketing and technology and development are depressing some of the current reported profits. So let's go ahead and get started. Currently going for $5.31 at a $202 million valuation. Just a quick look at some of the financials. Looks like in 2022, $96 million, and then in 2023, they finished with $84.7 million. A little bit of decline there, and that's one of the reasons why the stock has been on a slowdown. When we take a look at cash flow from operations, they are still making negative cash flows. And a quick look at the balance sheet, they have about $140 million in cash with no long-term debt. So a company with $140 million in cash selling for a $200 million valuation sort of opens up the questioning for this company on why it's selling for such a low valuation. But again, just for this video, I do want to just focus on pretty much this section in the income statement, and we'll just talk about some reasons why some of these expenses are depressing some of their current earnings. So some other general data real quick. We're just going to take a quick look on what's happening. There is a lot of insider selling. Usually when there's a lot of insider selling, it usually means the insiders know more than us, and they know that there's probably something bad about to happen to the company, and that's why they are all selling. Inside Holdings Group, which is a 10% owner, it looks like they're selling a lot of the 1stDibs stock. So I guess just by looking at this information, it's already a red flag. Why are there so much insider selling? But there is some contradicting information. When we take a look at some of the analyst ratings, they just recently got an upgrade from Evercore ISI last month, March 18, 2024. We take a look at Evercore ISI. They're a leading research department known for insightful and value-added content. Just from these two pieces of data, there is some contradicting information. Why is a major research firm applying an upgrade to this stock? But at the same time, it does look like a lot of the insiders are selling. I don't know the answer to that. Anyways, let's go back to what I wanted to talk about in this video, which is the operating expenses. Okay, so again, we're going to focus on this gray area right here that I highlighted. Basically, we're just going to focus on the operating expenses of 1stDibs. So I'm going to go ahead and sort of erase everything so I can start from the beginning real quick. We're going to go to 1stDibs. We're going to check out their financials and straight to their operating expenses. So total operating expenses, I'm just going to highlight that, copy, and we're just going to paste it right in. We've been going through the 1stDibs 10K. This is going to be their annual report for 2023. It's going to be the period ending of December 31st in 2023. So what I'm going to do is go straight to there, and basically we're going to go to the part where they talk about each section of the operating expenses. So what's in operating expenses? It's going to be sales and marketing, technology and development, SG&A, pretty much other provisional stuff that they added. So real quick, in the beginning, I was talking about how software drives today's economy. And since most software companies don't require huge assets to generate large income streams, they are focusing a lot of their money into sales and marketing and technology and development. For the people that don't know what GAAP is, it's generally accepted accounting principles. Basically, it's the rules of how things get reported in a financial statement. So everything in an income statement, balance sheet, cash flows, pretty much there's rules to how a company reports them. So pretty much under GAAP, they require all of this expenses to be immediately expensed in the income statement. Now, compare that to a company with huge assets. While GAAP does allow hard assets like property, plant, and equipment to be depreciated over many years, it recognizes that expense only gradually versus sales and marketing and technology and development, which must be expensed in that year. So old economy assets like factories, which are considered long-term investments, get recognized over 10, 20, 30 years in the income statement. The problem is tech companies like 1stDibs have little need for factories. Their biggest investments are in developing and marketing their products. This is where most tech companies will be putting their money in. But according to GAAP, most of these expenses are going to be expensed every year. There's going to be huge differences between an income statement of an old economy company and the income statement of a digital company. So enough rambling. Let's go ahead and put these numbers in. So we'll start with sales and marketing. Again, I'm just copying and paste it. 47, 44, 36. And we're also going to take technology and development. That's each year. So 2021, 2022, 2023. The next line that I have right here is advertising percent as a total of operating expenses. So pretty much I am just adding sales and marketing and technology and development and it's showing out of total operating expenses, 64% of the total operating expenses is going directly into sales and marketing and technology and development. All right, so the next line right here, advertising expenses per share. I want to see how much this is affecting their current reported profit. If the company decides to stop investing in sales and marketing and technology and development, how is it affecting their earnings per share? All I did was add sales and marketing and technology and development, and then I'm going to go ahead and divide those two numbers by the total amount of outstanding shares. This is outstanding shares in 2021, and that's going to give me advertising expenses per share. So this last column right here, this is going to be earnings per share without sales and marketing and technology and development. So say 1stDibs decides to stop putting so much money into sales and marketing and technology and development, would they already be profitable? I'm going to go ahead and take earnings per share. Pretty much have my earnings per share data all the way up here. Again, this is just copy and pasted. As you could see, 1stDibs has been getting negative earnings per share till 2023, but it does look like there is a trend to positive earnings per share on a side note. But anyways, what I'm doing is I'm taking earnings per share that they are reporting yearly, and I'm going to go ahead and take out the advertising expenses per share. So what this data is telling me right here is I'm taking earnings per share that they just reported. I'm just adding the sum, and I'm taking out the advertising expenses per share. Now, again, this is just a made up scenario. This isn't actually happening. I'm just trying to show you guys how their earnings per share would look like if they didn't spend so much on sales and marketing and technology and development, which isn't an expense in the long run, it's an investment. So what we get is they are already making positive earnings per share. And if we do that for 2022 and 2023, in an ideal world, in a different accounting standard where they aren't counting sales and marketing and technology and development, pretty much makes old economy income statements look unreasonably attractive, while all these new economy ones look unreasonably ugly. That's just how the rules work, and that's how things are reported. So anyways, I just want to show you guys why I think this could be a little bit undervalued. Do have $140 million in cash, which is a lot with no long-term debt, and they are spending a lot of their money in sales and marketing and technology and development, reinvesting and investing back into the business to acquire more customers. I feel like they are just currently depressing their earnings on purpose just so they can improve their business. Again, we'll just have to keep watching this stock. They are going to be reporting their first quarter earnings soon. I just wanted to show you guys some of the total operating expenses for this company. Anyways, let me know what you guys think. Do we think this company is a good undervalued investment, or am I just totally wrong? And by taking out sales and marketing, technology and development, is that a rational way to value technology stocks? Thanks again, everyone. We'll see you on the next one.